Alrighty, folks, we've got Fed Day. Fed Day normally happens on a Wednesday. I'm going to guess because of the U.S. elections, it's been pushed back a day. The Fed will meet Wednesday and release their findings, their opinion on Thursday. Before we start talking to Taylor about this week's Fed Day, I have to ask him about last Fed Day because, folks, if you don't recall, the Fed cut rates 50 basis points in a surprising move, and rates have only gone up. Taylor, explain this to me.
Rocket ship. So not to get too wonky on it, the Federal Reserve controls the very front end of the curve. They control the overnight rates. They control CD rates, money market rates, etc. Anything further out the curve, 5, 10 years in nature, is going to be dependent upon growth and inflation. And so when the Fed says, all right, we were going to do 25, or the market thought we were going to do 25, boom, you get 50. What that does is leaves the door open for more future inflation than what the market had perceived before. And then you get this back out in rates on the back end, which is negative for bond prices, obviously.
You know, I want to push back on that a little bit because obviously you're right.
But I'm always right. Joking. Go ahead.
That was good. The thing that I've been thinking about, because again, I've been in the recession camp for quite a while. Like it's part of the business cycle. We can't get away from it, right? I've always been like, hey, it's got to happen. But one of the things that I thought about probably like the first week after the rate cut was like, is the smart money, which is what I call the bond market, is the smart money actually discounting a recession? Right. One of the things that I was thinking about is, I know the inflation side maybe, but I actually don't think it's the inflation side. I think they think growth is going to be better than expected.
Those two are hand in hand, but yes, absolutely. So prior to the rate decision, we're coming off of, employment reports that are in July and August that are showing softness in the market. And what people are doing, to your point, well put, is they're building insurance into their portfolio, recessionary insurance in their portfolio. And then when you get September's blowout number, they go, no need for this insurance. We'll offload this back into the market, redeploy this capital somewhere else. So they're selling treasuries back into the market, backing up the back end. But growth and inflation should go hand in hand. That's typically the way the market, over the long term, right? There are certainly points of dislocation, but growth and inflation are going to go hand in hand. One of the best bond managers on the planet is a guy named Ken Leach. I used to work with him. He's in the Bond Market Hall of Fame, which there is actually such a thing. You got to be you got to be a real nerd to be involved in that. No one raises their hand and says I'm in the Bond Market Hall of Fame. But anyway, he used to say, "Tell me where inflation goes, I'll tell you where the back end of the curve goes." And that's the reality of what that is.
So again, I've never heard of this name. I'll go look him up after this. So, but basically, what I think you're saying is, if inflation goes up, rates go up. It's just that one-to-one relationship.
And it's future inflation expectations really that are going to dictate. Right. And so you look backwards, right? The back end of the yield curve through massive inflationary pressures of COVID stayed relatively muted. Relatively, like it went up, but it didn't go up meaningfully. And that's why, because long-term inflation expectations remained relatively anchored. And so that's why you didn't get an absolute unhinging of the back end of the curve when inflation was at 9.1% back in June of 22.
Got it. Well, one of the things that I'm just trying to play dominoes, right? I'm trying to figure out what's the second order derivative of risk capital or cost of capital being higher. Mm-hmm. And where my brain went is anywhere there's debt involved. I mean, so let me step back. So I obviously in the real estate space, I interact with a lot of the heavy hitters, and a lot of them were planning for 2025. They thought mortgage rates would be about 5.5. Mm-hmm. I've been telling them, dude, I think you're crazy. And now I'm telling people I think rates might be 7% for 2025. Yep. And why that's important is the fundamental business model of the guys that I interact with is different at 7 than 5.5. You're doing a lot more flipping at 5.5 than at 7. So I take that little microscopic fact and I try to blow that up to small and medium-sized business who is also dependent on capital. And I just think there's a lot less investment. There's a lot less stuff going on. And then, oh my God. And then I go to commercial banks, right? A lot of the commercial banks were starting to feel a little more confident because their portfolio of commercial real estate, they can kind of eke out no losses. Mm-hmm. at 5.5,
Mhm.
they're going to take massive losses at
Yep.
7 because cap rates and interest rates are related. So, I mean, I think a 7% mortgage rate, I think a 4.5% 10-year treasury, it's problematic for the economy in
Yeah.
2025.
Yeah, I think you're also getting the impact of not just, hey, what happened in the jobs market and it changed in September, and therefore you get the lift off of rates. You're also getting, and we talked about this on a prior episode, you're also getting a Trump trade built in here that the market believes, whether they're right, wrong, or indifferent, that the economy has more solid footing for growth in the future if Trump gets elected, and therefore the back end is going to back up on that. The other thing when it comes to mortgage rates is you should, I should not say that. There's a chance you get a reprieve in mortgage rates after the election. And why is that? Because a lot of what's playing out right now is banks building in the buffer
Right.
of, hey, we don't know where interest rates are going. And with that, the spread that you pay for a 30-year mortgage over a 10-year treasury is going to widen. And you can look at that in what they call the MOVE index. The MOVE index, the VIX, measures volatility or fear, right? In the stock market, the MOVE index measures volatility in the bond market. So that's going to tell you when the MOVE index is elevated, there's more uncertainty as to where the future of interest rates are going. Thus, banks are going to build in a bigger buffer. But once we get an election and we get some policy coming to fruition on the other side, you should have that uncertainty or the bandwidth, the variability of interest rates come in, thus driving down mortgage rates some. We'll see. I certainly could be wrong, but that's at least logical.
Yeah. So let me play that out. So again, let's say that does transpire. What I think you're saying is you will see a 10-year, like the average person will see a 10-year note lower Friday than it is today.
I'm not saying that. I'm saying that the 10-year note, irrespective of what happens.
So you're only on the spread.
I'm only on the spread on top.
Okay.
The spread on top. Yep. And but listen, like if Trump's elected, I think Trump's election is getting baked in right now from an investment price of things standpoint. That's why interest rates have gone up so meaningfully so quickly. If Kamala gets elected, you might get the 10-year falling back in some, saying that her policies are not as economically stimulative, and therefore you get the back end coming down. So therefore your 10-year could settle in. Regardless, the spread on top should come in some because the economic variability should start to sort itself out a little bit.
Yeah, but we've been talking about the spread on this channel a lot, folks. If you don't recall, I think it was about a year, maybe a year and a half ago, the spread between the 10-year and mortgage rates ballooned all the way to 311. Last time I saw it, it was at 265. For those that don't know, the average between a 10-year and the 30-year mortgage rate is about 185.
Yep.
So again, we have a lot. Mortgage rates can come in just by collapsing the spread to kind of tie this together.
Dumbing that down one step further. Basically, there's a full point additionally on mortgage rates, more than a full point relative to where the 10-year treasury sits, where it should normally be.
Yeah, there you go. So let's talk about Fed Day this week. Are you in the camp that 25 is a lock and we shouldn't even bother? It's just coming?
Yes.
I think you're in the camp like 99% of other people.
Yeah, it's funny. The weak number that came in, last week on jobs is going to leave the next two jobs. I don't even think the next one after that. So I guess it's, October, not November's jobs number, but December's jobs number is going to be epic in its importance because what we just got was we were in July in the summer, in August, weak employment numbers. September comes in, pops higher. All of a sudden we go from recession worries to we're all good, baby. And then what happens is October's number comes in and we know it's going to be low because of Boeing strike and because of hurricanes. And it comes in, the expectation was 100. It comes in at 12,000. So now the question becomes, okay, is there softening in addition to these two wonky events that threw off the number? Or did people just discount how much the number was going to be thrown off by that? And so therefore you look forward to the next month's job report and you go, oh man, now they're actually hiring additional people to deal with restoration from hurricanes. So therefore the number comes in high. Is it because the economy is so strong, or is it because, and then the next month at it probably settles in and people go, all right, this is the number that's actually going to tell us the natural health of the economy right now. And that's going to be 3 months after the last one that we got, what we thought was a true print.
So let me kind of play that out for the audience. So the other thing that I saw in this week's or Friday's 12,000 was they once again lowered the previous 2 months. I think
112.
the combined, yeah, 100, like over 100,000. So again, September looks less strong,
Yep.
right? And it's funny. I was talking to Claudia Psalm, right, the Psalm rule
Yep.
last week, and I told her I thought we might get a negative number for the job print,
Okay.
and we got 12. So close.
You were
I
darn
guess.
close.
I was
You
close.
get everyone on this channel. You're a rock star.
All you got to do is be nice and ask, and you get a lot of yes answers. But I think we might get a negative print. I think there'll be a revision next month, like there's been all year, and it will be a negative number.
I think you're more likely right than you are wrong. Right? Most. What was it? 2 months ago, we finally had a positive revision.
It was like 10 out of the last 11,
and it was like, wait, what?
You broke trend.
Right.
What?
You underestimated how good it was? Yeah, no. To your point, though, you're 100% correct. It's more likely that we get a negative number than we don't, just because I think it's been 14 in the last 15 months have been negative revisions downward.
Yeah. So let's talk about Claudia Psalm's interview. Obviously, if you may not know this, but she was one of the 9% last Fed meeting that called for a 50. She was in that camp publicly talking on Bloomberg and the like. So what she told me is coming, or her, as of the moment prediction, is 4 consecutive rate cuts of 25, and then the Fed is done. That's what she's thinking. How does that land? How do you feel?
Yeah. I don't know that I have a great comment as to that far out. If you talk to either one of the two of us, and I don't want to put number or words in your mouth, midsummer, the economic data wasn't that pretty. No, it's all about rate of change, and the rate of change was slowing pretty dramatically. Mm-hmm. Then we got one good number in September, and everything said, okay, all clear. We added 250,000 jobs, whatever it was, 254, I think it was. Then we got another week. So like the economic data right now is so opaque that it is really hard for someone to forecast that far into the future to say 25, 25, 20. And Claudia sounds a lot smarter than me. let's not shroud that at all.
No, she's wicked smart. Yeah.
So the Fed has to be data dependent. I know everyone absolutely hates to hear that, but that's the reality of it. Like as things come in, they need to forecast based on the new information that they're getting, but they have to be dependent upon what's coming in real time, at least as real time as they can find.
Well, let me ask you this question. Why the heck do you think the Fed is cutting when you have GDP close to 3%? You got unemployment, I think it was stayed at 4.1.
Yep.
I mean, there's people out there going, why are you cutting? The economy's doing great.
Yeah, it's just that neutral rate, which is this fictitious number out there that's a boogeyman of saying, hey, you're really restrictive right now. Whereas all the data doesn't really say it's that restrictive, does it? I mean, what they're doing is they're looking at history. Yep. They're saying, okay, what is federal funds rate at? And what is inflation at? And there's a number there that they're comfortable with. They're not entirely sure exactly what that number is, but right now they're almost 3 full % off where Fed funds is and where inflation is. Typically, they're in that kind of 1% off. And that's been the longer run recipe of success is keep federal funds a point higher than inflation or somewhere in that ballpark.
Right.
And they're just a long ways off right now. But we've now proven time and time again that things are a little different this time around, that when you stop the economy and then you inject as much money as you possibly can in the economy all in a 2-year window, like it throws things off a little bit.
Yeah, and that's where we'll close this conversation. And that's really the Claudia Psalm kind of discussion is like, where is this mythical R-star neutral rate?
Yep.
We talked in that conversation about a lot of the Fed presidents thinking it was 3%. We talked about Michelle Bowman thinking roughly it's 4%. Claudia seems to think that people are going to be pulled towards that 4% number. She thinks it's higher than it has historically been because of all the money printing and sloshing in the economy. And again, if that's the case, these people that were hoping for, 5.5% mortgage rate, it's not coming. I really do think the cost of capital is going to be higher in 25 than most people think.
Yeah. I don't disagree with you there. I would rather have them start talking about that neutral rate, not in what is the neutral Fed rate, what is the neutral spread over inflation? That's what I want to hear, is because that inflation is going to continue to bump around. So then you just continuously have to revise. Okay, now it's not 3, it's 275, and it's whatever based on that number. If it's everything is predicated on that, say, hey, inflation plus a point, inflation plus 1.5 or a half point. That's because otherwise your numbers are going to get revised all the time.
Oh, absolutely. This is a lot of fun. You put out something that people should go check out, lifegoalwealthadvisors.com/introduction. What are they going to get if they go there?
Yeah. So what you're going to get is just a 30-second taste of what it is we do as a business. We're wealth advisors. So we manage individuals, businesses, wealth, etc. And you'll get an idea of what it is we do different, all in 30 seconds right there.
Wow. And of course, don't forget to follow Life Goal Investments on Instagram. That's where I go for a lot of these 60-second education and motivation videos. Appreciate you.
You're the man, Michael.
Uh-huh.